The gearing ratio is a financial measure that shows the relationship between a company's long-term liabilities, such as loans, and its capital employed, the total funds used in the business. The gearing ratio gives an idea of how much of the company's operations are financed by debt compared to equity. The formula to calculate the gearing ratio is long-term liabilities divided by capital employed times by 100. When you're calculating the gearing ratio, the answer will always be a percentage. Before we look at high gearing and low gearing, let's look at some key terms that you should be aware of. Long-term liabilities are the company's non-current liabilities, so these are debts that are due in more than 1 year, such as a loan. Capital employed represents a total capital invested within the business. And equity refers to the ownership value in a company that belongs to its shareholders. It is essentially the difference between its total assets and total liabilities. It's important for you to know what a high gearing ratio is and what a low gearing ratio is. Now, a high gearing ratio is above 50%. It can be higher depending on the industry. A ratio of 100% or more means that the company has as much or more debt than equity, and that suggests a very high level of debt relative to equity. Now, a higher gearing can show that the business is willing to take risks. However, if profits fall, they could have difficulty in keeping up with loan repayments. For example, a gearing ratio of 150% indicates that the company has 1.5 times as much debt as equity, which is risky because the company could struggle to pay off its debt if market conditions worsen. A low gearing ratio means that the company is less reliant on debt and more reliant on equity, shareholder capital, to finance its operations. A gearing below 50% is considered moderate to low. A gearing ratio of 25% is generally seen as low. Now, low gearing can show that the business is risk averse, meaning that they do not really want to take risks. If profits fall, they are less likely to have difficulties in keeping up with loan repayments. However, without more borrowing, the business may miss out on opportunities. Ways to manage gearing. Companies often need to manage their gearing to ensure that they maintain a balance between financial risk and growth opportunities. High gearing can mean more risk, but low gearing might limit the company's ability to expand quickly. There are a number of ways that companies can manage their gearing ratio. Reducing debt. One way to reduce gearing is by paying off long-term debt. This could be done by using profits, issuing new equity, or selling non-essential assets. Another way is raising more equity. A company can issue more shares to raise equity capital. This increases the proportion of financing coming from equity rather than debt, reducing the gearing ratio. Another way is retaining earnings. Instead of paying out profits as dividends, a company can retain earnings and reinvest them into the business. This increases equity capital without the need to issue new shares. And finally, increasing profits. By increasing profits, the company can boost its equity, retained earnings, without needing to raise new capital. This helps improve the gearing ratio over time by increasing the proportion of equity relative to debt. Let's take a look at some gearing calculations. DEF Limited has £800,000 in long-term liabilities and £600,000 in capital employed. Calculate the gearing ratio. So we know that the formula is long-term liabilities divided by capital employed times by 100. So let's put those numbers into the formula. 800,000 divided by 600,000 times by 100. And that gives us 1.33 times 100, and that equates to 133%. A gearing ratio of 133% means that DEF Limited has more debt than equity. This is a highly geared position, which suggests the company faces significant financial risk, especially if it has trouble paying back its debt. On to another calculation. XYD Limited has £150,000 in long-term liabilities and 1.2 million in capital employed. Calculate the gearing ratio. Now let's put those figures into the formula. Long-term liabilities divided by capital employed times by 100. So that's 150,000 divided by 1.2 million times by 100. And that gives us an answer of 12.5%. Now, a gearing ratio of 12.5% indicates low reliance on debt. The company has more equity funding compared to its long-term liabilities, making it a safer investment. However, but one could consider, is this company making use of any growth opportunities? Thank you for watching this video. The next two videos that will appear on the screen are what YouTube thinks you should watch next.